All right, let's dive right into this explainer. Welcome to a complete masterclass based on Aswath Damodaran's The Little Book of Valuation. Now, if you're a BCom student gearing up for your MBA, studying for the CFA, or you're aiming for a seat in investment banking, private equity, or equity research, you are exactly in the right place. We're going to take you from an absolute beginner, maybe just learning the terminology, all the way to a confident junior analyst who's ready to tackle the valuation of literally any company.
But before we get into the heavy math, we've got to lock down one absolute fundamental truth, and it's beautifully captured by this classic Oscar Wilde quote. Price and value are simply not the same thing. In finance, buying an asset without having a clue what its true value is, well, it's basically like playing a very, very expensive game of musical chairs. You're just blindly hoping someone else is going to pay a higher price before the music stops. So our goal today is to teach you how to figure out what a business is actually worth.
Here's our roadmap for the explainer. We're going to build your toolkit step by step. We'll start with the underlying philosophy, move through intrinsic value and the DCF model, tackle risk and the cost of capital, pivot over to relative valuation, learn how to connect stories to numbers, and finally wrap up with a professional checklist.
Okay, let's kick things off with Section 1, the underlying philosophy of value.
Everything in our framework today comes straight from Aswath Damodaran's definitive text. They don't call him the Dean of Valuation for nothing, right? He basically distills decades of intense academic expertise into pure actionable mechanics. So keep in mind, this isn't just some dusty academic theory. This is exactly how the pros on Wall Street do it every single day.
So the first crucial hurdle is understanding the great divide in finance. Sure, there are dozens of complex models out there, but they really just boil down to two main approaches: intrinsic valuation and relative pricing. Intrinsic valuation is all about the fundamentals. It assumes the market actually makes mistakes about cash flows and risk, and your job is to calculate the true underlying value. Relative pricing, on the other hand, is driven entirely by market mood. You're looking at comparables to find bargains, assuming the market is right on average, but maybe wrong on a specific stock. To be a great analyst, you absolutely need to master both.
Moving on to Section 2, let's really geek out on that first approach, intrinsic value and the famous discounted cash flow, or DCF model.
Before you even think about opening Excel or starting the math, you have to ask yourself a huge fundamental question. Are we valuing the entire business, or are we just valuing the equity? If you want to value the entire business, you look at all the cash flows before debt payments are made, and you discount them using an overall cost of capital. Then you subtract the debt to find what the equity is worth. But you can also value the equity directly. To do that, you just look at the cash flows left over after the debt is paid and discount those at the cost of equity. The beauty is, if you do it right, both paths will get you to the exact same value per share.
Now, building a complete DCF really just boils down to exactly 4 non-negotiable inputs. First, you need the cash flows from existing assets. Second, you need the expected future growth. Third, the cost of financing those assets, which acts as your discount rate. And fourth, the terminal value, which is basically an estimate of what the firm will be worth at the very end of your forecast period. That combination right there is the pure engine of intrinsic value.
Take a look at how this actually plays out using Kraft Heinz as our example. You can literally see how professionals map out revenue growth and operating margins a full decade into the future to build the free cash flow to the firm. Notice how methodical it is. They project the operating income, apply the tax rate, and then subtract out the reinvestment needs to find the exact cold, hard cash generated each year. This is the absolute bread and butter of investment banking.
And this right here, this sensitivity matrix is where the magic really happens. It shows how just tweaking your assumptions for growth and operating margins can wildly swing Kraft Heinz's intrinsic value. See those shaded cells? Those represent values exceeding the market price of $36 at the time this was written. It visually demonstrates how analysts hunt for a margin of safety. You compare your calculated intrinsic value to the market price, and if the market is asking for way less than it's worth, well, you might just have a solid buy.
Okay, but projecting cash flows is only half the battle, right? Let's hit Section 3, risk and cost of capital.
Let's think about risk practically, using a company we all know like Disney. They face company-specific risks, like, say, the next $200 million Marvel movie totally flopping. They face sector risks, like massive shifts in the streaming wars affecting Disney+. And then they face massive macroeconomic risks, like rising interest rates or a global recession. But here's the kicker. As an investor with a fully diversified portfolio, those specific movie flops or sector risks actually wash out. The only risk you literally care about, and the only risk you price into your models, is that non-diversifiable macroeconomic risk.
So how do we actually put a number on that macro risk? Professionals use a metric called beta, which is the star player in the capital asset pricing model, or CAPM. Beta measures exactly how much risk a single stock adds to a supremely diversified broad market portfolio. A beta of exactly 1 means the stock just moves with the market. Above 1, it's riskier and more volatile. Below 1, it's safer. This is exactly how you translate real-world risk into a hard discount rate.
All right, shifting gears entirely now. Let's look at Section 4, Relative Valuation.
So imagine you see Cisco trading at 17 times earnings, Apple is at 21, and Microsoft is chilling down at 11. Figuring out who actually offers the best deal here means relying on relative pricing. Remember, this is less about strict future cash flows and way more about current market mood. You're hunting for bargains based on what people are willing to pay today for similar companies, using standard multiples like the price-to-earnings or PE ratio. There are 3 core steps to doing this right, and they sound simple, but they require sharp judgment. First, you have to find truly comparable market assets, your peer group. Second, you scale the market prices to standard multiples to make them apples to apples, using things like PE, EV to EBITDA, or price to book. And third, and honestly the most important, you have to adjust for differences. A company growing at 20% a year should naturally trade at a much higher multiple than one growing at 2%, right?
Now, here is a massive trap I see young analysts fall into all the time. When people use the PEG ratio, where you just divide the PE ratio by expected growth, they are implicitly assuming that growth and PE move in exact, perfect proportion. Like if growth doubles, the PE should double. But Damodaran warns us there is absolutely no math that says this is strictly true. Relying blindly on the PEG ratio can make high-growth companies look artificially cheap. You always have to understand the implicit assumptions hiding inside every single multiple you use.
Let's move to my favorite concept in Section 5, connecting the stories to the hard numbers.
Damodaran makes a brilliant point here. Valuation is ultimately a bridge. You can't just build a 50-tab Excel model devoid of reality, and you also can't just pitch a great story about a visionary CEO without the math to back it up. You must connect your qualitative stories, like an amazing brand or a moat, directly to the numbers. And you do that through 3 core drivers: revenue growth, operating margin, and investment efficiency. If a brand is truly strong, well, it has to show up in the financials as pricing power, which leads directly to higher margins. It's that simple. Let's bring all this theory onto the trading floor. Section 6, your professional valuation toolkit.
Listen, in the real world, you can't just close your eyes and guess what future growth will be. That's amateur hour. You have to calculate it. And this equation brilliantly illustrates how. You use core formulas like the reinvestment rate. Basically, growth equals the reinvestment rate multiplied by the return on capital. You are mathematically connecting how much cash a firm actually plows back into its business to the fundamental return it gets on those specific investments.
So here is your absolute go-to professional checklist. Number 1, decide right up front, value equity or the firm. Number 2, maintain consistency. Always match equity cash flows with the cost of equity and firm cash flows with the cost of capital. Don't mix them up. Number 3, ensure your growth assumptions are completely supported by actual reinvestment. And finally, never ever let your terminal growth rate exceed the nominal growth rate of the global economy. I mean, no single company outgrows the entire world forever, for sure.
Now, if you are walking into a Super Day interview for investment banking or pitching to a hedge fund tomorrow, keep this specific concept in your back pocket. A DCF model forces you to make assumptions explicitly. You literally type in the growth rate, you type in the risk. But relative valuation, it relies on those exact same assumptions, they're just implicitly hidden within the multiples. Explaining the difference in an interview shows you truly understand the deep mechanics of valuation rather than just knowing how to plug numbers into a standard template.
As we wrap up this explainer, I want to leave you with a real philosophical question to ponder. The next time you open up a stock chart or dive deep into a 10K financial statement, ask yourself, are you an investor seeking the true intrinsic value of the business based on the actual cash it produces? Or are you a trader playing the relative pricing game, just trying to guess what the market mood will pay tomorrow? Markets desperately need both to function, but if you want to survive, you absolutely must know which game you are playing. Thank you so much for joining me on this masterclass. And hey, keep building those models.